Now that you're buckled up and you've put on all your safety harnesses, as we discussed in the previous session, you may feel just a little more ready to buy your home. And a key element that will help you finalize this decision is your home loan. The home loan that you will take on towards buying this house is going to be a long-term commitment from 20 to 30 years of time. And that is why it is extremely important that you understand the various factors associated with your home loan and make a conscious decision of your home loan partner. The reason I call them a home loan partner is because they are going to be in your journey with you for the next 20 to 30 years for the entire tenure of your home loan. There are a number of factors associated with the home loan, small and large, which can have a lasting impact on your total outflow towards your home loan. That is why it is important that you understand each of these factors closely and make the right decision today when you are finalizing the partner whom you would want to seek the home loan from. In this session, we will discuss a number of questions that you may have, ranging from what exactly is a home loan and from whom can I get this home loan, what is an EMI and how is the EMI determined based on the interest rate and the tenure of the loan, and what exactly is the relationship between these three factors. What are the various types of home loans that are available in the market, and what are the features that differentiate a home loan from another, and is a particular feature something you must look forward to, and will it be a deciding factor in picking your home loan partner? Let's start with first understanding what exactly is a home loan. A home loan is an amount of money that an individual borrows from a bank or a financial institution at a certain rate of interest to be repaid every month in the form of equated monthly installments, or what is known as EMIs. We'll discuss more about what exactly is an EMI during the session. The property which the individual is buying is taken as a security against the money which is lent by the financial institution, which is called as the home loan. Let's look at some of the terms that are associated with a home loan. The first one is the principal. Principal is the total amount of the loan that you are borrowing from the bank or the financial institution. The next term is what is called the duration or the tenure of the loan. This basically refers to the period for which the loan has been advanced to you by the bank or the financial institution. This is the total period within which you need to repay the loan along with the interest back to the lender of the money. The next term that you must familiarize yourself with is the interest rate that is paid on the principal loan taken. So when the loan is given to you by the financial institution against the loan that is lent to you, you are charged a rate of interest which is determined both by the amount of the principal of the loan, that is the amount of the loan you've taken, and second, the duration within which you would repay the loan. So both the principal and the tenure of the loan, both of these determine the rate of interest that is going to be charged by the lender, and that is the interest you will have to pay over the entire tenure of the loan. EMI basically refers to equated monthly installments. This is basically a concept which has been brought up so that as an individual, you will pay an equal amount every month over the entire tenure of the loan. Generally, when you start off with a loan, the amount of loan is pretty high, and as you keep repaying a part of the loan on a regular basis, the amount of loan that is outstanding reduces. So does the amount of interest that is going to get charged to you on a periodic basis. EMI has been designed as an amount so that when you take the loan, you know exactly how much you need to repay on a monthly basis, and the amount that you need to repay remains fixed. Now, this is something which helps you a lot in planning your personal finances, because when you're talking about a loan for 20 to 20 plus years, you are not worried about what would be the amount 4 years, 5 years or 10 years hence, because the amount that you start repaying towards the interest and the principal of the loan remains fixed over the entire tenure of the loan, which makes it extremely easy to plan your personal finances. Obviously, every EMI that you pay to the bank has two components. One is the repayment of the principal portion of the loan, and second, a payment of the interest that is charged by the bank on the loan that they have given to you. Once you're familiar with the basic terms associated with the home loan, the next question is, whom do you approach for a home loan? When you're looking for a home loan, the first choice or the first person you must approach is your neighborhood bank. There are a number of reasons why the bank should be your first priority, and the most obvious reason is because they charge a lower interest rate compared to your other alternatives. Now, to be eligible to get a loan from a bank, it is pertinent that you have a good credit score. We've discussed what a credit score is in the previous session. So if you have a good credit score, to give you an example, a good credit score is something which is above 750. So if you have a credit score of more than 750, that is when a bank would be willing to entertain you. And the benefit of approaching a bank would be that you will enjoy a lower interest rate compared to your other alternatives. And what is your next alternative? Your next alternative is a HFC, or what is known as a housing finance company. A housing finance company is a type of a NBFC, which is a non-banking finance company which specializes in home loans. So a NBFC which specializes in home loans is called a HFC, or a housing finance company, and the primary business of a housing finance company is to extend loans for a purchase of a house. Now, the benefits that you will see around a HFC is that if you have a credit score which is lesser than 750, they would still be willing to entertain you, because by the nature of their business, they're willing to take that extra risk. But that risk is going to come at a cost for you, because the rate of interest that a HFC will extend to you is going to be higher than what a bank would offer you. So when you are not able to get a loan from a bank for various reasons, primarily being a not very good credit score, that is when you approach a HFC, and they would be your next best option for taking a home loan. If you think that you are not able to take a loan from a bank today, you can always approach a HFC, a housing finance company, take a home loan at a higher rate, and eventually with time, if you find that your credit score improves, you can always scout for a loan from a bank 4, 5, 8 years down the line and shift your loan from a housing finance company to a bank when you think it is financially prudent to make the shift. We will discuss about changing your home loan partner towards the last session of this course. Another major difference between taking a loan from a bank and an NBFC is that today when a bank lends you a loan, the loan is linked to what is known as the repo rate. A repo rate is an external benchmark which allows you to clearly see the change in the interest rate as and when the repo rate goes up or down. Whereas an HFC generally lend their money on a prime lending rate, which is more of an internal benchmark. So when you see interest rates reducing, you may not see the pass of the reduction in interest rates to you as a customer immediately or as fast as you would see in case of a bank. So that is another reason why you would prefer taking a loan from a bank than a housing finance company. Now that you understand the basics of a home loan and the choices that you have in terms of approaching a bank or a HFC, let's look at the 3 most important factors associated with your home loan. The first factor is the interest rate, which is basically the cost that you will pay to the lender for borrowing the money today. The second most important factor is the tenure of the loan. It is the period for which you borrowed the loan, or the time period within which the loan has to be repaid back to the lender. And the third important feature of the home loan which you must be aware of is the EMI of your home loan, which is nothing but the equated monthly installment through which you will repay the interest as well as the principal of the home loan back to the lender over the entire tenure of your home loan. Let's do a deep dive into understanding the interest rates associated with your home loan. Whenever you take a home loan, you have a choice between a floating rate of interest or a fixed rate of interest. Now, what do we mean by these two? A fixed rate loan is a loan where your EMI remains constant throughout the entire tenure of the loan because the rate of interest that is being charged to you remains constant, or as the term says, it is fixed. Whereas a floating rate loan is a loan where the rate of interest being charged to you is linked to a certain benchmark, and as and when that particular benchmark goes up or when interest rates go up, the amount that will be charged to you also goes up, and when the benchmark is lowered, that is when the amount that is charged to you in the form of the interest rate also gets lowered. So a floating rate, the EMI that you pay will technically change each time there is a change in the interest rates that is charged on a floating rate loan. Now, because of the nature of the loan, a fixed rate loan generally is 1 to 2% more expensive than a floating rate loan. This is because when the bank is lending you a loan today, they are fixing the amount they will charge you today for the next 20 years. So even when there are fluctuations in the interest rates, it's not going to impact you, and you're going to pay a fixed rate which is decided today for the next 20 years. Versus a floating rate loan looks more lucrative when you take it today for the simple reason that it is cheaper than a fixed rate loan. While a fixed rate loan is a fantastic option for a person who is looking forward to fixed regular payments, if you want a sense of clarity on what exactly you will have to repay, then a fixed rate loan is something you should look for. Whereas the floating rate loan, though it looks lucrative at some point in time, especially the circumstances prevailing in the economy, if the interest rates are at their all-time low, if you go and take a floating rate loan, you will be able to enjoy those lower interest rates. But you must bear in mind that tomorrow when the interest rates increase, you must be prepared for a higher payout for servicing your home loan. Now let's understand how exactly a floating rate is determined. Floating rate of home loans are today benchmarked to what is known as the repo rate. Repo rate is the rate at which RBI, which is the Central Bank of India, lends money to a bank. So when a bank borrows from RBI, they have to pay RBI rate of interest which is equal to the repo rate. And when they lend that money to you as an individual in the form of a home loan, they will add their margin and charge you a rate which includes their margin. So here, if you take an example of RBI lending money to the banks at a repo rate of 4%, the banks in turn will add their income margin of 3% and charge you a rate of 7%. Now what you must keep in mind here is that as the interest rate cycles move, if RBI were to reduce their repo rate by 0.5% or by 0.25%, that reduction is passed on to you either on a 6-monthly basis or on a yearly basis, depending on when the interest rate on your home loan is reset. Conversely, if the repo rate or the benchmark rate were to go up, the cost of borrowing for the bank goes up. At the same time, they will pass on the interest cost to you as a borrower, and you will end up paying a higher interest rate on your home loan. Purely based on the nature of the two products, the most popular of the product which is offered by both banks and HFCs is the floating rate of interest. The reason being, the banks and the financing companies are clear about the margins they want to earn on the loan that they are extending to you. So whenever the interest rates go up, they pass on the increase in the interest rate to you, and when the interest rates go down, interest rates meaning the benchmark rate, which is the repo rate we just talked about, when it goes down, they pass on the reduction in the rate also to you. And in this process, their margin of 3% does not change. 3% is taken as an example here, and their margins are largely protected and not affected by changes in the interest rates. Whereas when you look at a fixed rate of home loan, when the interest rates go up, it can have an adverse impact on the net margins of a bank, and if the interest rates go down, the banks tend to enjoy a better margin. Because of this variation, when you take a fixed rate loan and compare it with a floating rate loan, a fixed rate loan will always have a cost which is 1 to 2% higher than a floating rate loan, which makes the floating rate loan more attractive. It is not a straightforward choice between deciding to take a fixed rate loan versus a floating rate loan. A fixed rate loan, you're sure of the fact that you will have to pay only a certain amount of EMI each month and you're not affected by the changes in the interest rates. Whereas a floating rate loan is much cheaper than a fixed rate loan. And if you see today's interest rate environment, where we are at the all-time lows in terms of the rate at which you can borrow a home loan. So if you were to go and borrow a home loan today, you're getting home loans at sub 7%. But when you lock in your money at these low rates, you must be aware that tomorrow if the interest rate goes up, you should be ready to shell out a higher amount of interest. Whereas a fixed rate, you are locking in the amount you need to pay and you're not worried about the changes in interest rates tomorrow. Interest rates do not move like the kind of movements you see in the stock market, and they tend to have a more measured movement over a long period of time, and they are determined by one, the market factors, and second, also regulated to a certain extent by the central banker, which is RBI. Because of the long-term movements of interest rates, it is not possible to time or predict them very easily. You would choose between a fixed rate and a floating rate loan depending on what you're more comfortable with. If you want to enjoy a lower rate of interest today, you would pick a floating rate of home loan. Whereas if you are somebody who wants clarity on the amount that they would have to pay on a year-on-year basis and cannot deal with the fluctuations in the interest rate, then you would go for a fixed rate loan, although it's going to cost you 1 or 2% more than your floating rate loan. That said, when you talk to a banker or a financing institution, the default product they would offer you is a floating rate interest loan for the reasons we just discussed. The second most important factor that you need to understand with respect to your home loan is the tenure of your home loan. The tenure of the home loan is basically the period for which you are borrowing the money and the period within which the entire principal and the interest on the principal needs to be repaid to the lender of the money. While there is no minimum tenure for which you can take the loan, the maximum period for which a home loan will be extended to you would be for 30 years. One thing you must keep in mind is that the longer the tenure for which you borrow the money, the higher is the interest you will land up paying towards the end of the tenure of your home loan. And the tenure of the home loan is the only factor which is in your hand to a certain extent, wherein if you have the repayment capacity, you can decide to keep your home loan tenure at the lower end of 10 years or push it up to the higher end of 30 years as long as there is the repayment capacity for the particular home loan. To help you understand the impact of the tenure of the loan on your cash flows, let's take an example of a home loan which is taken for an amount of 1 crore at an interest rate of 7.5%. If this home loan of 1 crore is taken for a period of 15 years, the EMI that is calculated for this home loan works out to 92,700 rupees. So you have to pay an amount of 92,700 every month for the next 15 years. You will be able to repay the principal amount of 1 crore as well as the interest. Now the total interest cost, now this is something you need to pay attention to. The total interest costs that you will incur over this 15-year loan is an amount of INR 66 lakhs. So the total amount you will be repaying the bank is 1.66 crores over the 15-year period in the form of EMI payments of 92,700 rupees per month. Now, if you go back to the benchmark that we set in terms of a good benchmark of how much should be your EMI as a percentage of your income, we put the benchmark at 40%. Though a bank will be willing to lend you a higher amount, if you continue to stick to the benchmark at 40%, you should have a monthly income of 2.3 lakhs so that you can afford an EMI of 92,700 rupees each month. Now, what happens if I increase this tenure from 15 years to 20 years? if you increase this tenure from 15 to 20 years, you can see that the EMI that is required to repay this loan falls to 80,000. The reason it falls to 80,000 is I have 5 years extra to repay the interest and the principal amount to the lender. Now, as a result of this, though my EMI falls to 80,000, I am going to be paying this 80,000 per month for an extra period of 5 years. So the total interest that I will incur is an amount of 93 lakhs. So my interest cost for the same loan of 1 crore at an interest rate of 7.5% has gone up from 66 to 93 lakhs because I increased the tenure of the loan from 15 years to 20 years. And to be able to afford an EMI of 80% at the 40% benchmark, you should have an income of at least 2 lakhs per month, so that 40% of it goes towards EMI and the balance is used for your day-to-day expenses, and a certain portion also goes towards your savings. Now, if you increase this tenure of your loan from 20 years to 30 years, you can see that EMI falls from 80,000 to 70,000. Suddenly, a 1 CR loan where the EMI was 92,000 for a 15-year loan, it's just 70,000 for a 30-year loan. So, you are going to be paying an amount of 70,000 per month for the next 30 years to repay this loan of 1 crore. But what is important for you to look at is the total interest that you are servicing on this loan over this 30-year period is 1.51 crores. So your actual repayment of the loan of 1 CR will be a total of 2.51 crores. And you can see that amount is substantial for a 30-year loan. So as the tenure of your loan increases, the EMI would reduce because you have a longer period to repay the principal of the loan, but the total interest cost that you will incur would also increase drastically. So longer the tenure of the home loan, higher is the interest cost that you will have to bear, but that also reduces the EMI that you have to pay, and maybe it would make the home loan affordable for you today. So if you decide to sign up for a tenure which is beyond 20 years, be very sure of the numbers, be very clear of why you're signing up a longer tenure, and be clear of the interest cost that you will bear over the increased tenure of the loan. A change in the tenure of the home loan impacts you by increasing the tenure of the loan. You reduce the EMI that you have to pay for a particular amount of home loan. To look at it from another way, by increasing the tenure of the home loan, you would be able to take a larger loan when comparing two home loans with two different tenures. Let's take up the same example. If we assume that you are earning an amount of 2 lakh rupees per month, so the EMI that you can afford at 40% works out to an EMI of 80,000 rupees per month. So your capacity to pay is 80,000 rupees per month, and at an interest rate of 7.5%, with a tenure of 20 years, you can take a home loan of 1 crore of rupees. That is what you would be eligible for. And if you're eligible for a home loan of 1 crore, the value of the house that you would want to target to buy is going to be 1.25 crores. Now, when you increase this tenure from 20 to 30 years, the amount of home loan that you can take increases from 1 crore to 1.15 crores. So with an EMI of 80,000, you can either service a 1 crore loan for 20 years or a 1.15 crores loan for 30 years. Now, the moment your eligibility for a home loan goes up to 1.15 crores, the value of the house you can buy also goes up to 1.44 crores. So increasing the tenure, what it does is it increases your eligibility of the home loan and also then increases the value of the house that you can afford or the budget of the house that you can keep. But one thing you must keep in mind is increased tenure of the home loan also means a higher interest that you need to pay. While the higher interest is kind of lost in the EMI payments because the EMI payments remain fixed at 80,000 per month, they do not increase. What you sometimes do not budget for is your increase in overhead costs. We have discussed in the previous sessions the actual value of the house that you can buy is much higher than what you see on the hoardings. So if you decide to take a home loan of 1 CR, you will have to fund the down payment of 25 lakhs, and there would be the 18% overhead cost, that's 22.5 lakhs. So the total value of the house is going to be 1.47 CR. If you think that you can increase the tenure of the loan to 30 years and increase the eligibility of your home loan to 1.15 crores, keep in mind that you should be able to fund the down payment of 28.75 lakhs now, which was earlier 25, it has become 28.75 lakhs. And your other overhead costs would also increase from 22.5 lakhs to 25.87 lakhs. So increasing your eligibility for a home loan because you want to be able to afford a higher house today not only increases the tenure for which you are going to be repaying this EMI every month, but also you must check that you have that much amount of money in your account to be able to fund the down payment of 28.75 lakhs and also fund the overhead cost of 25.87 lakhs. The reason why you would want to explore increasing your tenure of the loan so that you are eligible for a higher loan for the same EMI that you can afford is if you are confident about the fact that tomorrow your income is going to grow at a much better rate than it has grown in the past. You will be able to save the additional earnings that you will have in the future and use that additional savings to prepay your home loan. The reason being, when you increase the tenure from 20 to 30 years, there is a drastic increase in the interest cost which may not be warranted or which may not be worth the higher tenure. So you would want to explore increasing the tenure just because you want to increase your eligibility of a higher home loan today if you are confident about being able to repay this loan at a date much earlier than the 30-year tenure, because you want to reduce the interest cost and not bear such a high interest cost over the increased 30-year tenure. The third feature of the home loan which you must be clear of is the EMI of the loan, or the equated monthly installment. The EMI is nothing but a fixed payment which is made by the borrower to the lender at a specified date every month for the entire tenure of the loan. Now, a EMI is nothing but a mathematical calculation which is determined by 1. The principal borrowed, that is the amount of the loan. 2nd, the rate of interest that you need to pay on the loan. 3rd, the tenure of the loan. And finally, if you have any moratorium or a waiting period for the loan. So when you take a fixed rate interest loan, the EMI is going to remain fixed for the entire duration of the loan. It is not going to change for the entire duration. Whereas if you take a floating rate loan, your EMI is going to change each time the interest rate on the floating rate loan are reset by your lender. It is very straightforward that if the principal borrowed increases, all else being equal, your EMI would go up. If your interest rate increases, all else being equal, your EMI would increase. And if the tenure of the loan is increased, all other factors remaining the same, your EMI would reduce. So EMI has a direct relationship with principal borrowed and interest rate and is conversely related to the tenure of the loan. Now the EMI that you pay each month is technically a repayment of both the principal as well as the interest component of the loan that you've taken. But because it is an equated monthly installment, the proportion of repayment in terms of principal and interest vary over a period of time. So if we continue with our example of the two-stage couple taking a loan of 1 CR which they're going to repay in an equated monthly installment of 80,000 per month for the next 20 years. If I show you the breakup of the principal and interest repayment for the first 5 years, this is what it would look like. In the first year, the total amount being paid by them is 9.6 lakhs and this remains fixed year on year. But what changes is the proportion of principal and interest repayment. In the first year, they would land up repaying an interest of approximately 7.5 lakhs and the balance 2.1 lakhs goes towards repaying the principal portion of the home loan. As time passes, the principal portion of the home loan that is outstanding keeps reducing, as a result of which the interest that is paid every year also keeps reducing. And towards the later years of your 20-year tenure, the interest component reduces to a very small amount compared to the principal repayment. So although you're paying a fixed amount of 9.6 lakhs every year, in the initial years, the proportion of interest that you pay is much higher compared to the proportion in the later part of the loan, because of which when you look at your home loan statement, you may realize that you've been repaying an amount of 9.6 lakhs every year for say 3, 4 or 5 years, but the amount of principal that has reduced is a very small amount, because in the initial years the amount that you pay towards the interest is much higher, and hence the reduction in the principal amount of your home loan is much lower. To help you understand this better, let's look at a tool which will show you the exact repayment schedule that you can expect when you take a home loan. If you open the loan amortization schedule, what you need to feed in right on top is the principal amount of loan that you plan to take. Add in the rate of interest which the banker is willing to lend the loan to you. Add the tenure of the loan in years. Once you put in these three variables, what this schedule is going to do is automatically compute what is the amount of EMI that you will have to pay to be able to service this loan at the mentioned interest rate and the mentioned tenure for that particular principal that you plan to borrow today. If you come down, you will actually see a breakup of the total EMI that you are paying into the interest and principal portion. So in the initial years, you can clearly see that a major portion of the EMI goes towards paying the interest, and a much smaller portion is utilized towards paying the principal of the loan. It's only towards the later half of the tenure of your home loan, the amount of principal payment as a percentage of your total EMI exceeds your interest expense. Now this tool not only shows you the monthly breakup of what you can expect, but it also summarizes on a yearly basis what is the total amount you are paying towards the home loan, which is your EMI is multiplied by 12, split between the amount that is going towards the principal payment and the amount towards the interest payment. The reason why these two are important is they help you determine what is the amount being used to repay the loan. So that is actually your equity in the home because you've repaid the loan to that extent, and what is the cost that you're incurring. In addition to that, the breakup of these two amounts also helps you determine the tax benefit that you can get under the different provisions of the Income Tax Act, which we've discussed in detail in our next session of understanding the tax benefits associated with buying a house. This schedule should give you a clear picture of what is the kind of outflows you can expect over the entire tenure of your home loan. One thing that you need to understand with respect to the EMI is that when the floating rate loan changes, your EMI would change. Usually the home loans offered are floating rate interest loans. So as and when this interest rate increases, your EMI would increase, and increase by how much? Let's have a quick look. So if you take a home loan which is at a 7% rate, your EMI for a home loan of 1 crore and a tenure of 20 years would work out to an amount of 77,530. If this interest rate were to increase to 7.4%, the EMI goes up to 79,000. And when this interest goes up to 8.4, the EMI goes up to 86,000. And when the interest goes up to 9%, the EMI goes up to 90,000. You can easily plug in these numbers in the loan amortization schedule shade and see the impact of a change in the interest rates on the EMI that you need to service. The reason why you must do this is tomorrow when the interest rates go up, you must know whether you will be able to afford a EMI of 90,000 rupees per month or not. Today the interest rate may be at their low of 7.5%, but if they were to increase to 9%, your EMI goes up to 90,000. You must be prepared for the eventuality of having to service a EMI of 90,000 per month versus a EMI of 77,500 when you took the loan. So though the EMI is an equated monthly installment, it will remain fixed only in the case of a fixed rate home loan. If you're taking a floating rate home loan, as your rates change, your EMI is going to be reset each time the interest rate changes. Now this reset can happen once in 6 months or once in a year, or it will happen at a periodicity which is mentioned in your home loan agreement. It is important that you do this stress test to understand that if there is an increase in the interest rates by 1 to 2%, what is the amount of EMI I will look at and whether I would be in a position to service this EMI or not. Another factor that can affect your EMI is if you decide to prepay your loan. So if you have a loan of 1 crore, you've been servicing it for the last 5 years and today it has reduced to an amount of 78-79 lakhs. If you decide to make a prepayment of the loan, there are two things which will be offered to you by the bank. One is either you reduce the tenure of the loan, so your EMI remains the same, but because you've made a prepayment, your outstanding of 78 lakhs reduces to say maybe 60 lakhs or 65 lakhs. The reduced loan can be paid at the same EMI that you've been paying till now, and that would effectively reduce the tenure of the loan because you are able to repay the principal at a faster rate. The second alternative is the bank would recompute your EMI so that your tenure of the loan remains the same, but your EMI reduces. Why does the EMI reduce? Because you've done a prepayment of your principal, the principal portion of your loan has reduced. So you have an option here where you can service the loan over the remaining tenure, but because you made a prepayment, the EMI that you need to pay reduces because of the prepayment that you've done. Now that you understand the three most important factors associated with a home loan, let's look at the various other terms and various other charges that you must be aware of when you apply for a home loan. We will also look at the various tweaks or the various features around a home loan which are offered by different entities and do an analysis of what kind of feature works for what kind of a cash flow that you are facing as an individual. The first thing that you need to understand is the home loan charges that are charged by banks and other financial institutions when you make an application to them for a home loan. The amount can be charged either as a fixed percentage of the home loan or as a fixed amount. It can be a single charge, it can be a bundle of charges. Let's understand the various terms or various charges that you can expect when you make this home loan application. The first one is the application fee, which is a non-refundable amount charged by the lender when you make an application for a home loan. This fee ranges from 2,000 to 6,000 rupees, and this is purely a fee for the application made, and it is a non-refundable amount even if the loan is rejected by the lender. In addition to the application fee, banks and financial institutions tend to charge a processing fee, or which is also called a administrative fee. This fee can range from 0.5% to 2% of your home loan, or it can be a fixed amount which is charged by the lender. This generally also includes the amount they'll end up paying the broker who is able to source the loan for these institutions. In addition to the processing fee, what is commonly charged is a stamp duty for the agreement that is entered between the bank and you, and the stamp duty can vary from 0.1 to 0.2% of the home loan. In addition to the stamp duty, it is not uncommon to see banks charge a technical and a legal assessment fee. Since the bank is supposed to vet the property against which they are going to extend a loan, they would want to do a detailed assessment before they can decide to give the loan to you. Through the legal assessment, the lender will gauge if the property is free from any encumbrances and there are no legal complications around ownership of the property. And through a technical assessment, the bank will assess what is the true worth of the property, because the amount of loan that they will give you is benchmarked on the value of the property, and the maximum loan they can extend to you is 80% of the value. So through the technical assessment, they arrive at what is the real value of the property. In addition to a technical and legal assessment, banks also charge what is called a home loan documentation charge, which is basically for getting an ECS activated, and these charges can be as little as 500 to 2,000, which they call as documentation charges, to ensure that the repayment of the loan is set up at the time of giving the loan. In addition to setting up the ECS for repayment of the loan, documentation charges are also charged for the fact that the original home loan agreement is kept by the bank branch safely in a location for the entire tenure of the loan. And the banks may be doing this either on their own, or they may be hiring third-party services. And if there is a charge associated with this documentation, they may pass it on to you as the borrower. In addition to all these charges, you must also be aware that although there is no GST applicable or charged on the interest that you pay to your banker, there is a GST payable on the various charges which are charged by the bank, the charges that we've just discussed about. So you should budget for an additional 18% of GST over and above the charges which are charged by the bank for processing your home loan. So when you're scouting for your home loan, it is extremely important that you understand the various charges that will be charged by either the bank or by the housing finance company, so that you don't feel you're shortchanged when you start seeing a host of charges coming up after the loan is approved and before the disbursement. When you're asked to pay a number of charges, you should not feel shortchanged. Be very clear and take an upfront written acknowledgement from the person from whom you're applying the home loan to as to what are the expenses he must expect, whether they are given out separately or they are bundled together into a single charge. Be very clear of the entire list of charges that you would be expected to pay as a borrower of the home loan. In addition to the home loan charges, another large expense that you will expect when you decide to take a home loan is your insurance charges. Now you may be wondering, what exactly is an insurance charge? When you buy a home loan, the banks make it mandatory that you should have a home loan insurance. Now what exactly is a home loan insurance? A home loan insurance is basically an insurance which is given by a third party, an insurance company. For a premium that you pay to the insurance company guarantees that if the borrowers of the home loan die due to an unforeseen circumstance, then whatever is the amount of the outstanding loan, that will be paid by the insurance company. So basically what this means is that when you take a home loan from a bank, the bank would want to protect its interest that if something happens to you tomorrow, since you are responsible for repaying the home loan, and if you pass away tomorrow due to unforeseen circumstances, they will be left with a home loan which nobody is going to service. To protect themselves against that risk, they would ask you to take a home loan insurance wherein you pay a certain premium to an insurance company, and in the event of your untimely death, the insurance company would clear the entire loan and none of your dependents or your family members would then have to worry about having to repay that loan. Taking a home loan insurance is prudent because if something were to happen to you, you do not want the liability of the home loan falling on your dependents. The alternative to taking a home loan insurance is to have adequate term insurance. Now to help you understand the difference between the two, a home loan insurance only covers the outstanding amount of the home loan, and in the event of your untimely death, the outstanding amount of the home loan is repaid to the bank by the insurance company. Whereas in case of term insurance, when you buy the policy, you sign up for a certain sum assured and the entire amount of sum assured is paid to you and it is not linked to your outstanding home loan. While the home loan insurance amount is paid to the lender of the loan, a term insurance amount is paid to the beneficiary or the nominee of your policy. A home loan insurance covers only the home loan outstanding, whereas a term insurance pays out the sum assured and it has a broader cover because the amount can be used to pay the home loan or for other alternative purposes also. It is not uncommon for the home loan insurance premium to be added to the loan amount given out by the lender, whereas if you take out a term insurance policy, the premium will have to be paid separately by you directly from your bank account. While the home loan insurance premium is paid one time at the time of taking out the loan, a term insurance premium is generally paid on a periodic basis, which can be either monthly or yearly. While it is not uncommon to see your banker forcing you to take a home loan insurance, as per law, neither RBI nor IRDA mandates you to take a home loan insurance. It is a part of the internal policy of the bank to decide whether they are going to make the home loan insurance compulsory or not. Now you as a customer can always ask the banker to give you the cost of the premium and look for a competitive premium from vendors other than the insurance vendors which are offered to you by the bank, because it is possible that the home loan insurance that you take from a bank will land up being more expensive than taking a similar insurance from a outside party. As a customer, you're free to tell the bank that you would want to compare the rates and then decide from whom you would want to take the home loan insurance. The alternative to a home loan insurance is to have a term insurance. The idea is that you don't want your family to be burdened with your home loan or your liability which is there if something were to happen to you. So it is extremely prudent to have either the term insurance or the home loan insurance to protect your family from this unnecessary liability if something were to happen to you. From looking at the various other charges that you would be expected to pay as a home loan borrower, let's look at the various terms and other factors you must consider and be aware of when you're taking a home loan. The first one we want to look at is the difference between a co-owner and a co-borrower or a co-applicant. A co-owner is basically the person who is the legal owner of the property, whereas a co-applicant or a co-borrower is the person who is applying for the home loan to the bank and who is responsible for paying the loan back to the bank or to the financial institution. Now, every co-owner will compulsorily be a co-borrower when you take a home loan, but every co-borrower need not be a co-owner. To give you a scenario, if you take the example of the two-stage couple, both Krish and Ananya, they are the co-owners of the property which they are taking because they have bought it jointly. When they go and apply for a home loan, they would both be the co-owners as well as the co-borrowers in this case. And if the bank thinks that they do not have the financial capacity to pay the loan, they may decide to have Krish and Ananya add another co-borrower. Say Krish's father joins in as a co-applicant or a co-borrower of the loan. So when a co-borrower joins in, he says that if the other two applicants are not able to service the loan, he takes on the responsibility to service the loan, which acts as an additional safety factor for the bank, because of which you can have a co-borrower who is not a co-owner of the property. One thing you must clearly understand that if you want to take the tax benefits associated with the home loan, which we will talk about in the next session, you have to be both the co-borrower as well as the co-owner of the property. So in this case, Krish and Ananya, both of them, they are the co-borrowers and the co-owners. They can avail the various tax benefits with respect to repayment of the principal of the loan or repayment of the interest on the loan. But Krish's father, who is also a co-borrower but not a co-owner, cannot avail of any of the tax benefits under the various provisions of the Income Tax Act. The next factor that you need to understand is when can you expect the disbursal of the home loan. Now this will depend on the kind of property that you plan to buy. If you are planning to buy a ready to move in property, generally the entire home loan is disbursed at one go after you've made the down payment for that particular property. Once you made the down payment, the entire home loan is disbursed as a single payment to the seller of the property or the builder, and you start paying the entire EMI from day one of disbursal of the home loan. Whereas if you decide to buy a home which is under construction, then what happens is your home loan is divided into two phases, which is the pre-construction phase when you get possession of the property. So in case of under construction property, the home loan, although may be sanctioned at one go, the disbursal of the home loan happens over a period of time, which is directly linked to the amount of construction that is completed for that particular property. So you can have, say, 10% of the loan disbursed in first year, 20% in the second, 40% in the third, and the balance only in the fourth year, while the amount of disbursement is a function of the construction. During this period of under construction, or technically till the date you get possession of the property, you are charged only an interest on that portion of the loan that has been disbursed. And it is only after you get possession of the property that the EMI or the equated monthly installment starts coming into picture. So if we continue with our example where Krish and Ananya want to take a home loan of 1 CR for an interest rate of 7.5% and a tenure of 20 years, if they decide to go for a property which is under construction, the amount that will be disbursed will be a function of the construction that takes place, and the interest that they will have to pay will be only on that portion of the loan that has got disbursed. So in year 1, if it's only 10 lakhs that is disbursed, they will pay an interest of 7.5% on the 10 lakhs divided by 12. So the pre-EMI they'll have to pay will be only INR 6250 per month. As the amount of loan being disbursed increases, the amount they have to pay each month also increases. What you need to clearly understand is the amount that is being paid before the date of receiving the occupancy certificate or before the date you move into the property is known as a pre-EMI interest. So during this period, you are not repaying any principal portion of the loan to the lender. You are only servicing the interest portion on the loan, and only on that portion of the loan that has been disbursed to the builder because the property is still under construction. It is only when the construction of the property is complete and you receive the occupancy certificate for the property, that is when the EMI would kick in, and it's after 3 years, in the 4th year when you receive the occupancy certificate, your actual EMI start only in the 4th year, and it is from this 4th year that you count your tenure of 20 years because you started your equated monthly installment only in the 4th year after the entire loan was disbursed. So it's very important to understand that what you're paying till the date of receipt of the OC of the property is only pre-EMI interest. You're not repaying any loan portion, you're only servicing the interest that is outstanding on the loan. Now that you have become familiar with these various terms and factors associated with the home loan, let's understand 2 variants of the home loans which are offered by various banks and financial institutions, and should you choose these variants or no, and how they can benefit you. The first one is the home loan interest saver. Now what exactly is a home loan interest saver? Under the home loan interest saver scheme, you are provided the flexibility in terms of depositing any additional sums of money that you have in your account so that you can save on the interest that will be charged on the outstanding principal. In simple terms, if you have any surplus money which you do not need today but you may need it tomorrow or you may need it 2-3 months down the line, it is obvious that you do not want to use the money to prepay your home loan. But what you can instead do is, if you keep the money deposited with your lender, then what happens is when they are computing the total interest that to be charged on the outstanding principal, the extra money that is lying in the savings account, because you do not need the money today, is reduced from the principal of the loan outstanding, and effectively you are charged an interest which is lower than you would have been charged in a regular scenario. So if you have a EMI of 80,000 that is due, but you have a surplus of 20,000, you park that 20,000 also in your account. What the banker would do is, when he is computing the interest to be charged on your loan for that particular month, he would reduce the loan amount by this 20,000 which is deposited with the bank, and effectively you pay an interest which is slightly lower to the extent of surplus of funds that you have parked in your account. This is a money which is lying parked in the account. This is not a money that you have used to prepay the loan. So tomorrow when you need the money, you are free to withdraw the money and use it for any other requirements that you have. But by parking the surplus, it helps you reduce your interest to a certain extent. And if you are a person who constantly has a certain surplus lying with him, it can have a good impact on the total interest over a period of time. A second variant of a home loan is what is known as a home loan overdraft facility. What happens in case of an overdraft facility is, whenever you have a surplus amount, you can deposit these into the home loan account, and this surplus deposited is treated as a prepayment against the principal amount. While this is a prepayment, the bank also offers you an option which is known as an overdraft facility, under which in case you were to need these amounts sometime in the future, you can always go and withdraw the money from the loan account. So what happens is your home loan account becomes similar to a overdraft loan account, wherein as and when you need funds, you can go and withdraw the money from the account. And obviously the limit of how much you can withdraw is set by the bank based on the home loan you've taken and your home loan limit. And as and when you have a surplus, use the surplus to deposit it into the account, and that is treated as a prepayment against the principal amount. Generally, a home loan that comes with the overdraft facility, you will find that the interest rate for such a loan is slightly higher than the interest rate for a plain vanilla home loan. And it is extremely important then that you evaluate whether the kind of cash flows you would have as an individual, you would want to pay that extra interest and avail the overdraft facility. So if you are a salaried person, you would prefer a plain vanilla loan, whereas if you are a business or a professional with erratic cash flows, that is when you may want to consider an overdraft facility, because that gives you the flexibility to withdraw amounts as and when required, but that comes at a additional higher interest cost. Two examples of the two varieties of home loans we discussed about is the home loan interest saver scheme offered by IDFC First Bank and the home loan overdraft facility offered by HDFC Home Loans. While the first option for you to take a home loan is your bank and the second option is the housing finance company, a very commonly asked question is, should I borrow money from my friends and family for my home loan? Borrowing money from your friends and family comes with a number of benefits, such as that you don't have too much of paperwork to be done, which can take weeks when dealing with any of the financial institutions. You don't have to worry about your credit score because your friends and family are extending the loan to you on good faith and they are not going to be checking your credit score. It saves on a lot of time that goes in getting a home loan sanctioned, and you do not have the EMI pressure, or you would have the flexibility when you borrow money from your friends and family. At the same time, you continue to enjoy the tax benefits for the interest payments under Section 24B, even when you pay the interest to your friends and family. While there are these benefits associated with borrowing from your friends and family, you must be very clear that you do not want to spoil your relations because of the loan that you've taken from your friends or from your family members. So it's extremely important that when you borrow money from a family member, you get the transaction documented so that it is very clear what is the amount you've borrowed, what is the interest that you will pay, and what is the tenure by which you will repay this amount. You also want to ensure that you are always paying your amounts within the stipulated time and you are not defaulting, because you do not want to mix the relations which you have with your family and friends with the money that you've borrowed, and that would actually tend to have a negative impact when you start delaying in your payments or defaulting in your payments. So while there is no restriction on borrowing from your friends and family, you want to exercise this option with precaution. Another thing you need to be aware of is, while you will get the income tax benefit of the interest that you pay up to 2 lakhs under Section 24, when you borrow money from your friends and family, you will not be eligible for certain other deductions which are available under Section 80C, Section 80EE and 80EEA, which we will discuss in detail in the next session on the tax benefits associated with borrowing for buying a house. To put together all the various factors that you must consider when taking a home loan, always research your options well. Today, with all the information easily available on internet, with a click of a button, you will be able to access the various features offered by different lenders, and you will also find a number of portals which will do the comparison for you and help you choose between which option is right for you for your requirements. Always choose a suitable EMI. Do not be tempted to go for a long tenure loan just because it reduces your EMI, because the interest cost will go up drastically for a longer tenure of the loan. So always choose an EMI which fits into your repayment capacity. Maintain a good CIBIL score so that you're able to procure the loan from a bank and you don't have to approach a housing finance company for the home loan. Be extremely clear of the additional charges that are being charged by the lender of money, so that you don't feel that you have landed up paying a higher amount in terms of the other charges associated with borrowing money. Be clear of the interest rate that you're choosing, whether you're going for a fixed or a floating rate. And when you're going for a floating rate, be aware of the fact that you should be budgeting for an increase in interest rate and be able to service the EMI in case of increase in interest rates. And even when you are going for a fixed rate of loan, be sure that there is no clause in the contract which allows the bank to reset even a fixed rate loan on the happening of certain events. Be clear of the fine print so that you do not land up with a heavy loss over the longer period of time, because a home loan is going to stay for 20 to 30 years and you want to be clear of the terms and conditions associated with the home loan. Be clear of the repayment terms, including if at all there is any prepayment penalty associated with your loan. Also know of the foreclosure norms associated with your home loan. It is extremely important that you read the documents clearly before you sign off on a home loan, and take the help of a lawyer if you're not able to read the terms on your own, so that a legal person can explain you clearly the various terms and conditions associated with your home loan. Do not sign off on documents blindly just because you want the loan to be processed as quickly as possible. To sum up the 3 learnings from this session, you can avail a loan from a bank or a housing finance company and choose between a fixed or a floating rate, wherein the floating rate loan is the most common product that you will find in the market. Your tenure and the interest rate of the loan will determine your EMI, and you should avoid being tempted to increase the tenure just to make your EMIs more affordable. And before you sign off on the home loan documents, it is important that you check through all the documents in detail, be clear of the charges that you need to pay, you are clear of the terms and conditions associated with the loan, and you do a thorough study, take a legal opinion if required, and only after that you sign off on your home loan documents. The next session will talk about the various tax benefits associated with buying your home.